Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, September 12th, and what an end to the week for news we have, folks. We have a lot to get to today. We're breaking down everything you need to know about the Microsoft OpenAI peace deal that appears to be coming together. We're also going to get into the Paramount bid for Warner Brothers Discovery and what that could mean for both of those companies. We're then going to bring on Jay Das at Sapphire Ventures to help us understand what this crazy week in IPOs and crypto IPOs in particular means for the market more broadly. We're going to end with two conversations about how one startup is selling AI to Wall Street and why tech companies aren't buying social media platforms anymore. It is going to be a busy show, but a great one. Let's get right on into our first segment. Last night, Microsoft and OpenAI said that they have reached a tentative deal that will see OpenAI restructure its very complicated governance. This is part of a long-running saga that we have been covering for many months and years here at The Information, and yet it somehow never gets less complicated. I want to bring on our Microsoft reporter, Aaron Holmes, to help us make sense of all of this. Aaron, welcome back to the show. It's great to have you.
Hi, Akash. Happy to be here.
Okay, so you must be exhausted. This is very hard to understand, and the incremental details themselves are very complicated. So help us understand what the news was, and then we'll sort of get into the backstory about how we got to this point.
Yeah, so for now, there's still a lot of unanswered questions, but what we do know is that Microsoft and OpenAI said they've reached a tentative non-binding agreement about the next phase of their partnership. And reading between the lines, OpenAI is trying to restructure as a for-profit entity still owned and controlled by its nonprofit, which would allow it to raise more money and go public. But to do that, it needs Microsoft's permission. And as a result, the two companies have been basically locked in negotiations over the past year over what that's going to mean in terms of Microsoft's stake in the for-profit entity, as well as a whole host of other questions like how Microsoft will keep getting access to OpenAI's technology, especially the most advanced technology, which would be, AGI, which is on par with, a human intelligence when OpenAI eventually reaches that.
Right. Okay, so we're going to get into some of those details, but the thing that really stood out to me is they said tentative non-binding. I mean, that sounds about as walking on eggshells as anything. Why do you think they actually decided to put out this announcement if things are still getting hashed out?
I mean, I think it's clear that the two companies want to signal that they're getting closer to a deal. It is in both of their interests to ultimately reach some sort of agreement. OpenAI needs to keep raising money in order to keep powering its extremely cash-hungry business. And Microsoft needs OpenAI to be able to keep raising money so that it can keep spending so much on Microsoft's cloud servers, as well as, keep developing cutting-edge AI that Microsoft has been using to power the bulk of its AI features over the last few years. So they might not see eye to eye on every tenet of their agreement, and I'm sure that there's still some last negotiations that they're working out. But this is them essentially saying to the world that they are getting close to a deal.
Okay, and with this news that came out last night, I mean, is there a winner at all in this?
I mean, it still remains to be seen. We know that one of the top things that Microsoft has wanted is continued access to OpenAI's technology, even when the startup achieves AGI. Currently, their previous contract stipulates that Microsoft would lose access to OpenAI's technology at that point. So the exact kind of way that has been hammered out has yet to be seen. There have been reports that the AGI clause is still in their new contract, but has been modified somewhat, but we don't know exactly what that means yet. And at the same time, of course, Microsoft wants a sizable stake in the for-profit entity. Currently, It only has profit units that would entitle it to future OpenAI profits rather than a traditional stake.
And one thing I was hoping you could explain to us is they talk about the exclusive access to OpenAI's technology. I mean, as far as I know, OpenAI's models are used very widely. So what exactly is exclusive about this, and what are they negotiating there?
It's a really good question. So right now, Microsoft has the exclusive rights to resell OpenAI's models in the cloud, meaning if you're a company that wants to use OpenAI's models in your products, you basically have to go to Microsoft Azure in order to get those models, and that has become a huge business for Microsoft. We've reported that surpassed $1 billion in revenue last year and has grown a lot since then. So that's one big piece of the exclusivity, and Microsoft also gets the rights to reuse OpenAI's models without paying the startup, per token like other companies do, which it has the exclusive rights to do. So it remains to be seen whether those things are going to continue beyond the current deal term, which is set to expire in 2030.
Right. And last question for you, big picture here. I mean, why should we care about this deal at all? I mean, from my view, it doesn't feel like as a consumer, ChatGPT is going to change that much. But talk to me about the bigger picture here. I mean, is this weighing on other parts of the AI ecosystem?
Yeah, absolutely. I mean, the individual consumer might not see a big difference when OpenAI is able to raise money and go public, but OpenAI's ability to keep spending heavily is arguably kind of holding up a big corner of the economy. I mean, it just signed a $300 billion deal with Oracle. It has committed to
Money that
spend
it doesn't have.
right that it
Yet.
needs to keep raising, and building out data centers and continuing to sort of fuel that demand is hugely important both to the tech world and the broader US economy at this point.
Great. Okay. Well, if those stakes aren't high enough for you, well then I don't know what is. Aaron Holmes, thank you for coming on. Aaron covers Microsoft here at The Information. We're going to keep the show going with our second segment here. It is stunning that this next story was the second biggest news that happened yesterday. Paramount Global is putting together a cash bid for Warner Brothers Discovery, according to the Wall Street Journal. Warner Brothers Discovery shares went shooting up on the news. It would cost Paramount something like $71 billion, which would include all the debt that Warner Brothers Discovery has on its balance sheet. This is a monumental deal in media. And given that the Ellison family is behind it, there is also a tech angle. And so I want to bring on our co-executive editor, Martin Peers, to talk all about this. Martin, happy Friday to you. I know that you are very excited to talk about this one because it is tech, it is media, it is billionaires. I mean, gosh.
It's everything.
It's everything. Okay.
This
Well,
story has everything.
so the thing that I want to ask you is, when people have said AI is going to eat media, I mean, media. So AI, this is not what they meant, and yet this is kind of central to the whole story in a way.
Yeah, I don't think it's a case of AI eating media. I think it's a case of money being made on the AI front, flowing through to media and um, rescuing the investors in Warner Brothers who've, have been holding on to this stock, which has been in the toilet for years, and they're getting bought out. So, the rich is buying out the poor
Right.
in a sense. So that's what makes this a great story. It kind of unites the two stories of AI, which is on the rise, and entertainment, which is on the decline.
Right. So that's big picture what it is. It just granularly. I mean, explain to us tactically what you mean here. How is that money going from AI into media? Explain to us sort of the Oracle connection to all this.
Sure. So Paramount is now controlled by the Ellison family, the same family that controls Oracle. The news this week that Oracle had signed these big new AI cloud deals sent their stock soaring and enriched Larry Ellison. So he now got even more financial resources to invest into Paramount and to finance Paramount's purchase of Warner.
Okay. So we have this news, this deal could go through. We're not really sure, where it is in the process yet. But my question for you is this a good deal? Is this a good idea?
I mean, it could be a great deal for Ellison, depending on if it works out. I think it's a risk. It's a very risky deal. Warner and Paramount, I mean, he only bought Paramount a month ago.
Right.
And both of these companies are very reliant on cable, which is a declining business. So, and also Warner has a huge amount of debt. So if he buys Warner and puts it together with Paramount, the combined company is very exposed to a declining business. I mean, you have to remember anybody could have bought Warner, but no one wants to pay up for those declining cable
Right.
channels. So, there's a big risk here.
But although one of the things that you've written about is the potential for Warner Brothers Discovery to split its business up. And one of the questions that we were talking about this morning is why not wait for that split to happen and then buy the part of the business that isn't declining.
Yeah, you would think that Ellison would have waited, but the problem was that split isn't due to happen until next year. And then I think there's a tax reason that after that split, when he could have just bought the streaming operation and the studio, which will be carved off, but I think he has to wait 2 years for tax reasons. So if he waited, he'd be probably waiting till 2028 or so.
Okay.
And I think he obviously wants to sort of move faster.
Okay. So now we've talked about sort of the risk here and the bear case, I guess you could say. What is the flip side of that? What could be the bull case for this?
Yeah, well, the upside is that he manages to figure out, I mean, firstly, putting them together catapults him into a very strong position in Hollywood. I mean, Warner and Paramount together, the two studios are very well positioned. The streaming operations would also be very well positioned. They'd be able to compete more effectively with Netflix, Amazon, Disney. The only question is, he's got the debt he'll be taking on, and he's also got the declining profits. And the studio and the streaming don't make that much money. So can he improve the profits from those fast enough to offset the declines in the cable business? And that's the question, which is very hard to sort of
Right. Very quickly before we let you go, we also had the big Murdoch news this week that Lachlan Murdoch has control of the family empire. You didn't write about it this week in the briefing that much. I don't think, at least.
I read a small bit.
Small bit. Give us the big bit. Give us the big bit.
Well, look, the interesting point about that story, everyone has been writing that, Lachlan won this long, tense battle. I would argue that the winners were really James Murdoch and Elizabeth and Prudence, who are getting out. I mean, who wants to bet on Lachlan, who now has to run Fox and News Corp on his own? That's not a bet that I would take. So I think actually they are the ones who are making the money. They're getting out. So
you think it's okay? Yeah, that's a good way to think about it. The way I was thinking about it really is just, I mean, how much news we got this week with the landscape and media shifting once again. I mean, new owners, new conglomerates. Seems like it changes every couple of years, and so the story will continue to unfold. Martin, thank you for coming on the show. Martin is our co-executive editor, and he is the author of our nightly newsletter, The Briefing, here at The Information. Okay. The Winklevoss brothers' crypto exchange Gemini is going public today. It is the third big tech IPO to happen this week. We also had Figure, another crypto company that debuted yesterday, and Klarna, which listed shares earlier this week. I want to bring on a close watcher of both the crypto and the IPO markets. Jay Doss is the president and co-founder of Sapphire Ventures. He is a longtime friend of the show. Jay, welcome back. It's great to have you.
Yeah, Akash, thanks for having me. It's great to be back.
So we had a busy week this week in IPOs, which is not something that we've said in a while. Looking back on these three, tell us about your reflections and what we learned about the IPO market more broadly.
Yeah, so the first thing is that these are all mostly fintech IPOs. Of course, Black Coffee was the chain, but even then, if you look at it, they're very different companies. Klarna is actually a consumer lending company, which is very different than Figure. Which is, doing a lot of things with blockchain, but I almost think that they are more of an enterprise company that is trying to redo how mortgages are sold and loans are given on a blockchain. And then we have Gemini, right? Which is kind of an exchange. You could also look at them as a digital asset treasury company. So, it's going to be interesting to see what happens with the pricing for Gemini.
Right. And I mean, we've talked about this a little bit on the show before, but is this the IPO window opening? Is something structurally changing about the IPO market in your mind here?
Yeah, I do think that there is a lot of appetite for IPOs, not only just from institutional investors, but also a lot of retail investors, right? I do think that if you look at how the bankers are nowadays structuring the IPOs, I think I read somewhere that the Gemini IPO, 30% of it is being sold to retail.
Yeah, through Robinhood and some of these newer platforms.
Exactly, which is very different, right? Typically, previously IPOs when you had, you would sell maybe 10% to retail, if that, right?
Huh.
But I think there is what these companies and the bankers are doing is really giving this appetite to the retail investors. Because remember, a lot of the hedge funds, a lot of the, crossover funds, they do have access to these companies through, even when they're private, when they do these big tender offers and these big rounds. So
Right.
this is really capturing the retail kind of appetite for IPOs.
Right. And I mean, we're also at this place in the economy where rates are starting to come down. And there's also that factor there that, that might be sort of opening up the markets a little more.
Exactly, right? People are looking for growth, and there's a lot of capital kind of sloshing around in the system. And some of that is also kind of pivoting back from, more credit and debt oriented instruments, because as you said, the interest rates are coming down and people are looking for growth. But in general, I think the risk appetite has definitely changed. I know, the economy kind of, is giving different signals depending on what you want to look at. But I think there are people out there, both retail and on the institutional side,
Right.
really looking for growth stocks. And that is why the IPO market is doing so well.
So now, over the last couple of years, we've talked about this bar that it's not just you, but everyone has said $500 million in ARR. That is kind of the bar for going public. I think that equates to something
right.
like a $5 billion market cap.
That's
Last time we had you on the show, when Figma IPO'd, you basically made the point. I don't think the bar has really changed that much. With these structural changes happening in the economy, do you think that bar is coming down at all, or are we still at 500?
No, I think look, even Gemini is selling 425 million at the kind of at the IPO. But what has happened, I think, is if you look at the Gemini IPO, it's kind of interesting. They actually reduce the size of the offering. In some ways, they basically decrease the supply so that they can get a really nice pop and have on the upside. But I do think that is why, since the way that these IPOs are being structured, I think a lot of institutional investors, even if they buy, if they get allocation, they're not going to buy in a huge way until there's more liquidity and float in the stock.
Right. But what about the size of the company? Like 500 million ARR. Does that threshold change for you?
Yeah, I think that threshold is still there. Like, you look at Figure, that's like over 7 billion in market cap. I think Gemini is like pricing at like 3.5 billion. So I do think that, maybe the bar, is not at 5 billion, but also this is the life cycle of IPO. If you look back in history, typically at the beginning, you really get the tippy top companies, the 5 billion, 10 billion mark is kind of what is people looking for. But then over time, as there is more and more of these IPOs and more people want to buy them, companies go out with maybe not those kind of metrics and not as much float. So I can see that, in the next 12, 18 months, there will be companies going out with much smaller market caps, and the float will be like maybe 100, 150 million. The question is, what happens to those companies long term?
Yeah.
Right? They end up in PE hell and get acquired, or do they actually able to survive and execute and meet and beat the forecast and actually become a big company?
Can you help me understand? You talked about Gemini's sort of people seeing it as sort of a digital asset treasury company, and that's kind of an interesting view, because I was looking at the financials. I mean, I was comparing it to Coinbase, right? Coinbase, it's a profitable company. Revenue is growing at Coinbase. At Gemini, revenue contracted. If you look at the first 6 months of the year this year versus the first 6 months last year, revenue's contracted and operating expenses have gone up. So I'm not really seeing what the case here is for the company. You're saying, hey, they have crypto on their balance sheet. Just buy the stock.
Exactly. Like, look, there are companies like that trading out. Their strategy is like, which was previously called MicroStrategy, is a great example, right?
Yeah.
They're basically holding Bitcoin, each dealer, and there are a couple of other companies kind of doing that. So I don't know what the market, it's going to be interesting to see how it prices and what happens on the trading side, because, at some point, if there's a lot of retail investment, it doesn't matter the fundamentals of the company. It almost
just a meme stock at that point. It's
a little bit. I would say complete meme stock.
I know, yeah. But
Right,
you know, loosely.
Yeah, exactly. It kind of, what people are talking about on Reddit, on, all of these, social network, that's kind of what drives the price of the stock and not the fundamentals. I think you find out the fundamentals over time in 6 to 9 months when the lockup expires and the company has provided 2 or 3 kind of quarterly results. So yeah, it is very hard to sometimes analyze why a stock is kind of, going up versus going down, right?
And the thing about these treasury companies too, that I don't really understand then is, if the sort of competitive thesis for investing in this company is the fact that it's a treasury company, well then really the treasury company, it's hard to, they're different businesses with the same cryptocurrencies on the balance sheet.
That's right.
Why do you buy one treasury company versus the next? It's like, I don't know.
Yeah, exactly. I personally don't know. But look, I think that is the challenge with fintech stocks, right?
Yeah.
I think fintech stocks are not like software stocks where, software stocks, you have ARR and, GRR and NDR. Those are kind of, and, margins. Those are the key metrics. Fintech businesses are always complicated because you'll have, some things on your balance sheet. You'll have some stuff, maybe you're selling directly to the consumers as a lending instrument. You might be so fintech. I think stocks are much difficult to analyze for a lay person. Of course, bankers and
financial statements are very confusing. Like, you really have to get an expert to read the cash flow statements because it's not the same.
Exactly. But look, I think overall, I think it's good for the market that there is appetite for all of these IPO stocks and that, people are getting liquidity, people are trading. Because you want that in some ways, as I keep saying that, it is good to be public companies because you have the regulation kind of overview, but it just makes you operate as a much, much better company while you're public versus staying private.
Right. Great. Well, Jay, thank you so much for coming on the show. It was a busy week for IPOs, and I suspect that things might get a little bit busier. And so we will have to have you on more to make sense of all of these initial public offerings. That is Jay Das, the co-founder at Sapphire Ventures. Okay. Well, we all know just how important Bloomberg terminals have become to Wall Street. At least one company is hoping it can use AI to take at least some of that market share away from the terminal. AlphaSense was founded more than a decade ago, but AI has helped lift its valuation to $4 billion last year. I want to bring on the company's CEO, Jack Coco, to help us understand how Wall Street is thinking about this emerging technology. Jack, welcome to TITV. It's great to have you.
Thanks, Akash. Thanks for having me.
So explain to us what exactly the platform is for starters.
Well, AlphaSense is the technology behind the most important decisions in the corporate world across from Wall Street to corporate boardrooms. It's basically an AI search and market intelligence platform that puts the right insights at the fingertips of decision makers at our clients. Companies like Google, Pfizer, JP Morgan. And what they're doing with it is really analyzing what they need to know as they're acquiring companies, making investments, launching new products, entering new markets, all the major value creation activities in business, where it really matters that you have the confidence from having the right data and insights at your fingertips and really can make a difference in your competitive edge against companies that don't have this kind of capability at their hands.
So you've got, I mean, I've used the platform. You've got not just the financial data, but you've got the research reports, you've got the SEC filings, you've got news, you've got expert analysis that you guys do. You kind of put it all into one platform, and now you're using AI to sort of make sense of all that data for people. It's certainly a very helpful tool. My question is, why can't a company like Bloomberg, which I think is probably the closest analog people know for something like this, why can't Bloomberg just build something like this with AI?
Well, I may not be the right person to ask.
I should go ask Michael Bloomberg.
We've entered this space to come and innovate something new that wasn't being done before. We saw these sort of traditional legacy data terminals providing access to a lot of content. I used these as an analyst back in the day in my investment banking days.
Yeah.
And they were great at providing access to a lot of information. But what they didn't do is actually help you really find it. You had to manually go and look for it and spend a lot of time. And what we wanted to build is a capability, a semantic AI-driven search capability that helps you find all the relevant data points and now uses AI to really pull it together, do chain of thought reasoning,
Right.
and kind of tie that together in a really strong narrative so that users can have the right information at their fingertips. And we haven't seen anybody else be able to do that yet. So
with the AI component,
and then the other piece is actually, sorry, it's the content where, as you mentioned, our expert transcript library is actually a major proprietary content set that we acquired a company last year called Tigas and have been really aggressively expanding that, and that provides a lot of proprietary insight that you can't find anywhere else. So even these sort of very large legacy data terminal companies do not have access to a lot of this intelligence that you get through AlphaSense.
And so tell me about that expert research that you guys are doing. So do you have a team of people that is then going in and doing primary research with experts, or are you using AI agents to run these interviews? Like, well, what does that research look like?
Well, the majority of it is still us facilitating venture capitalists, private equity professionals, and hedge fund people doing interviews every day. 20,000 calls per quarter with experts in the corporate world across, from former executives, customers, partners, competitors of every one of those companies to really dig deep into what matters for those companies. And now what we've added is, to your second question, we've added an AI interviewer, actually, where we're also able to send that to interview all of these experts and have really smart conversations, a half an hour conversation with an expert on sophisticated technologies, and that's able to add even more scale to the library.
So you're kind of betting that this data the primary data that you're collecting, that is kind of the moat, I guess, because it's the quality of the data essentially that it's better for anyone using
the quality
this
of the data, the breadth of the insights, the unique insights, and of course the technology that ties it all together.
Right.
We've seen, heard from clients where private equity firm told us recently they'd spent a month doing research manually on a market segment where our deep research product gave that same or even better, in their words, report in 10 minutes. So that's the kind of thing that really differentiates us.
Right. I do want to ask you, so your company is more than a decade old, and you've sort of been around for, I guess, call it the pre-ChatGPT era, and then now you're building in this AI era. And one of the questions that we've been talking about here at The Information is how people have evolved their business structure to sort of take into consideration the costs of AI and building in the AI era. How have you seen your cost structure change in the last 3 years compared to 10 years ago when you were building what may have otherwise been sort of a more traditional software business, I guess? Are you seeing a much larger percent of your costs now go towards paying for these models that you're using in the background? Are you having to adjust pricing? What does that look like?
Well, firstly, we actually founded the company as an AI-first company before anybody was really thinking this way. So we used a lot of the prior generation of AI capabilities to create pretty smart semantic search. Of course, what generative AI has now done is kind of taken this through to the vision of a human being able to talk to a machine and get a really smart human level answer back. Now, what we're able to do now as we're doubling down and using generative AI really heavily across all our product, of course, we're investing in a value proposition, and we're taking very consciously a gross margin hit because it makes sense to kind of add that intelligence, add all those trillions of tokens our system is consuming in order to give the best answers to a client. So it makes sense. Our clients are getting a lot of ROI and they're happy to pay for it. And as a result, it makes sense for us to invest to do even more of that.
Right. Great. Well, Jack, thank you so much for coming on the show. It's a fascinating platform. Like I said, I was using it this morning actually to research the Gemini IPO that is happening today, and it did alert me to actually something that some of the previous guests mentioned, which is the fact that 30% of the shares are being issued through or distributed through these retail trading platforms. That was something I didn't know. That was something that AlphaSense told me. And so it's a great platform. Thank you so much. That is Jack Coco, the CEO of AlphaSense. Okay. For a long time, tech companies were very interested in buying social media platforms as that category became more popular with consumers and with advertisers. But new data from Quartermass Advisors shows that the advent of AI has caused interest in those platforms to crater, at least as it relates to M&A. I want to bring on Quartermass James Creech, who published that report this week, to tell us more about the data that he's collected and what could explain that trend. James, welcome to TITV. It's great to have you.
Thanks, Akash. Happy to be here.
So let's talk about this report that you put out. Tell us about the data that you found.
Sure. So we did some extensive research into the history of acquisitions by social platforms. So looking at Facebook, Instagram, so Meta's activity, YouTube, TikTok, Snapchat, the number of acquisitions they've made essentially throughout their history, right? 2007 to present. And there's been a noticeable decline in the past 5 years, which is attributable to a number of factors, some of which include the technology shifts that you mentioned, right? We're moving into a new AI landscape. And so the focus of a lot of these businesses have changed. But we've also undergone some significant macro changes and political changes as well.
Okay. So now when we're talking about social media platforms, I mean, we're talking about the big tech companies buying platforms like WhatsApp, Instagram. That was ages ago. But we're also talking about like smaller purchases that you track too, right?
That's right. Yeah, there have been some headline acquisitions, like you mentioned, billion-dollar deals with WhatsApp, Instagram, ByteDance buying Musical.ly. But there have also been a number of smaller, more strategic tuck-ins. Meta noticeably, made a number of acquisitions in the metaverse and gaming space for a number of years. They've shifted their focus to a lot of AI acquisitions recently.
Right.
Snapchat bought a calendar app for high school and college students called Saturn recently. So, there have been admittedly less deals than there were in the heydays of the 2010s, but certainly still some activity going on.
Sorry, Snap bought a calendar app for college students?
That's right. So it's essentially a social calendar app that says, hey, these are the classes I'm taking. These are the activities I'm involved in. So in their bid to kind of stay relevant to youth, they wanted to have an integrated feature to understand how people are relating to their friends IRL, not even just on the Snapchat platform.
Got it. And so now let's go back to the reasons for why these social platform acquisitions have gone down. So I guess, what are we saying here? Like, what's the bigger picture? Is it that social media is not an interesting business model anymore? Is it that, we've heard of OpenAI, for example. I think they've talked about building their own social media platform with AI. Like, what's the bigger story going on here, do you think?
I think it's a few things. Number one, the strategy has shifted. So the playbook used to be, well, let's acquire our competitors before they become too large. That was certainly the case with Facebook buying Instagram back in the day. Also, a number of efforts, to purchase Snapchat over the years. But instead, they started copying each other's features. A lot of social platforms feel very similar or offer, a number of similar features today. The public market pressures have shifted from growth at all costs to rewarding profitability, right? And so the idea of, well, the cost of capital's increased, there are rising interest rates. As a result, there are fewer acquisitions and more of this effort of, okay, let's invest in, acquiring more users organically or looking at other approaches for growth. And then finally, there's been a lot of political scrutiny, right? This pressure against big tech, this antitrust and regulatory frameworks that are making it more challenging for these big tech giants to make larger acquisitions.
And another report that you put out, you also track acquisitions broadly in the creator economy. Tell us about what you found. Acquisitions are actually, broadly speaking, they're increasing in the creator economy.
Significantly so. Yeah, it's interesting. The creator economy is on a tear, and there's a lot of interest and activity in the space. I think a lot of that is driven by strategics realizing, hey, we want more of this capability, this DNA in-house. And so we're making a big bet on the creator economy.
Right.
We've also had a number of newer players enter the space. So,
and who like what for people who aren't familiar, who's buying and who's selling in the creator economy right now?
Sure. So the targets in the creator economy are services businesses like influencer marketing agencies, talent management firms. They can be software companies that are providing tools for creators around content production, distribution, monetization. There are, creator-driven businesses. You've got creators launching these CPG brands or other products to sell through to their fans. The buyers tend to be incumbents, right? So some of these strategic players in markets that, Hershey's buying Sour Strips, for example. They say, hey, there's this trend of creators building, a new candy brand. We want to own that market share. We want to be a name in that space. We want to protect that category. But you also have, large native companies like Patreon making acquisitions in the creator economy, or strategics saying, hey, we want to own social media software or influencer marketing software, and they're making acquisitions of new entrants in the category.
Right. Great. Well, James, like I've said earlier, I mean, the data it's high quality data, and I love reading your reports as they come through. So thank you so much for coming on the show and sharing it with us. That is James Creech, the founder of Quartermast Advisors. Well, that does it for today's show. A reminder that we are live on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We really do appreciate your viewership. I am already excited for our next show on Monday. And so until then, have a great weekend. We'll see you soon.